Where do we get capital to be able to invest? The first thing we always go after in the low return on equity witch hunt game is the net savings from our income minus our expenses. Many of our investors save anywhere from $50,000 to over $100,000 annually because a lot of our folks are accredited investors, which is commendable and can help achieve financial goals pretty quickly. These savings are ideal for investing in real estate deals, preferably running it through your accredited investor banking, which is the new improved version of infinite banking, as the money in savings accounts or money market accounts tend to lose value due to inflation. The second place you get capital to start investing is your cash on hand. Of course, it's advisable to have some emergency savings, especially for individuals who own their own businesses. You have payroll, you have some cash reserves there. But non-business owners or most of our investors who work W-2 day jobs can run with as little as $20,000 or maybe at most $30,000 in their bank accounts. Now, our accredited investor banking system, which is the new and improved infinite banking, provides an ideal place to store this cash while earning a stable tax-free return. To learn more about that, thewealthelevator.com/bank, or send us an email at team@thewealthelevator.com to get that free e-course. Now, the third place most investors will find capital to start investing will be in your lazy equity in your home. Most investors focusing on this type of avenue will either go after a HELOC, cash out refinance, or selling the property. Now let's break down these three options. The HELOC is an attractive option and it incurs very minimal fees and only charges interest on the drawn amount via simple interest. However, it may not grant access to the entire equity of the house. So for example, you've got $1 million house, $1 million of equity. The bank may only give you a HELOC up to, say, 70% of it. So you're not getting access to the full amount. Nevertheless, it serves as a convenient starting point for most investors, allowing them to start investing with a few $100,000. And it takes a while to invest in deals, especially when you're starting to build your network with other purely passive accredited investors within our community. As investors progress, they will eventually exhaust the HELOC amounts. And at that point, you have to go to the second option, cash out refinance. Now, the problem with the cash out refinance is you're going to have to pay fees. Mortgage brokers will probably increase the interest rates to compensate for the fees and sell it off as a no-fee loan. Now, don't be fooled by that, right? There are fees in refinances, and although it may be hidden, they're there. But this allows you to fully optimize the amount of proceeds that you're going to get from your refinance. And of course, it might make sense to just sell the house that you live in, rent. Heck, that's what I do because that's the best use of my money, and to grow your net worth. And I've got a lot of other content for people who don't have a net worth of over $1 million or $2 million. I have a general loose rule of thumb that upsets some people because disqualifies a lot of people from buying a house. But that rule is, unless your net worth is 2 or 3 times greater than the house that you're buying, you probably shouldn't buy that house. And you probably need to invest your money because you're going to make a greater return, especially in value add type of real estate deals. That means if you're going after a $500,000 home, you probably shouldn't buy it until you have $1 million net worth. Sorry, if you can't get the money out of your home, and some are investors, their spouses say, no way, Jose, you just can't get the money from there. The last and final place some of our investors will get investment capital from is through their qualified retirement plans. Now, I use this word pretty loosely, QRPs. Everything that is 401ks, 403bs, TSPs, IRAs, Roth IRAs, this all falls under qualified retirement plans, QRPs. So while traditional investments like stock markets stuff may not be ideal for those under the third floor of the wealth elevator that we talk about in my new book, they still generate some returns, which is why the QRP money is last on this lazy witch hunt money list to get capital to start investing. Now, there are consequences when withdrawing money from your QRPs, and that is going to be based on where your current AGI is. Now, I've done a lot of coaching calls on this in the past, and we bust out the tax brackets and we see where you're at in terms of AGI, and that determines whether it makes sense to withdraw your QRP money or leave it in there for the time being. Now, if you don't make that much income, if you're under $300,000, $360,000 adjusted gross income, it may make sense just to pull that money out, which clashes with a lot of what were taught out there originally. To learn more about these wealth building strategies and alternative investments, check out our group, thewealthelevator.com/club, and we'll see you on the inside.